What's up, traders? This is Ferris with Trade with Tex, and today we're going to be kicking off the third video of the Learn to Trade YouTube series. So today we're going to be discussing specifically when to trade, right? How do you know when is the best opportunity? I'm not just talking about, 9:30 to 11:30. I'm talking what are the technical signals that tell you that you should be actively trading that day. And in addition to that, when to stop, right? When to hang it up. For a lot of new guys, once you start learning the ins and outs of trading, this is a huge obstacle. It happens to everybody, so we'll talk about the second part of that as well, okay? Real quick, I had COVID, took me a while to recover, so I haven't put out a video in a while. If you are not a member on the Trade with Tex website, you can join us for free for a week. Just visit the link in the description below, okay? But let's talk about it, because specifically what I want to discuss are what are the signals here, right? What are the technicals behind this and how do you know when to trade? So first things first, we have to address the problem, right? The problem at hand is obviously with regards to, people just selling too early, not riding the whole move out, or you have the flip side of it where you're just not trading at the right times and you're getting stopped out frequently before the move plays out. So most of that can be boiled down to just basic risk management, right? Where you're setting your stops. But there is a really simple solution that I use and that we use in the chat room regularly to get into trades and to stay away from trading altogether for that day, okay? Now, the solution in general can be boiled down to two things, so I want to just simplify this. Number one, only trade strong trends, and that's what we're going to talk about, just using a basic rule solely based off of strong trends in order to make sure that we are only trading when there is the most opportunity. Number two is the 15-minute rule, and this is a little bit more advanced. I actually didn't want to put this in the video. We've acknowledged the problem, we've acknowledged the solution, what exactly needs to happen, right? It sounds easier than it is, but let me show you one simple thing that you can do to make sure you're not having this problem and solving it if you do have it. So basically, whenever the markets get a little bit volatile, right? Right now we're in a bear market, we have, a lot of ups and downs, and the rallies are vicious. So if you get too biased, you can take some bigger hits, right? You can take a big loss, and that's all it takes to blow up an account. So in order to limit that and limit your overall bias, all you got to do is follow technicals, right? Simplest thing, add a basic moving average to your chart that has a good balance between a lower time frame and a somewhat kind of medium to large size length of that moving average, so you know that certain times of day, based off of how that moving average is sloped, you can trade, right? Now, stick with me here for a second because I'm going to simplify it even easier than that. Basically, first thing you got to do is add the moving average to your chart. So most of you guys probably already know how to use moving averages. It's day one stuff. And all we're going to do here is add a moving average with a length of 8. But the tricky part here is that you can either add an exponential one or a simple one. Everybody has their personal preference. I will go over the best moving averages on all time frames for this rule. But basically the rule of thumb is if this moving average that we have, right, we're going to be using the 5-minute time frame and we're going to be using the 8 EMA. So this can be a simple moving average or exponential. I prefer exponential for this rule, okay? So we set our chart to the 5-minute. We set this EMA to 8, right? That's the length of it. So both of these are relatively low numbers, right? This is a lower time frame. This is I would say about medium number here, 8, right? It's not too low, not too high. So what we're doing by finding this balance between these two time frames is saying that if this moving average is sloped upward aggressively, right? We have a slope that looks like this for the 8 EMA, then we know it's time to trade, right? And we should only be trading long unless it's at a reversal level, okay? That's a big, subtext there. If we're at a huge level of resistance, don't follow the trend up, right? It's as simple as that. Wait for the break and hold if you're really that into it, but just be patient for that, right? Sit it out. Now, with the slope going upwards, it works the same way. Downward, as long as it's sloped aggressively, right? The actual angle of this slope is aggressive. Then it doesn't really matter which direction you're trading it. If it's up, you trade it up. If it's down, you trade it down. So once you've gone through, and in Thinkorswim, I'll show you how to add this, but at the very least, try the 8 EMA on the 5-minute. That's what we use in chat. With whatever platform you have, pause the video, add it, right? Go to simple moving average, exponential, and just set it to the 8, okay? Then you go back to your chart, and I'll show you what it looks like with my actual chart here. Okay, this is the NASDAQ, just a standard QQQ ETF. It doesn't matter if you trade penny stocks, options, futures, whatever, it's universal. This is a really good example of how you use it intraday. So for QQQ, this is, I believe, Friday's action from last week. And this is set to the 5 minute, right? So again, make sure you're just looking intraday. That's the open, this is the close, and you're on the 5 minute. And this little pink line that I got here is the 8 EMA. Right, I've drawn a line to it so that we could look at this slope a lot more easily. So what this is telling us is that typically we want a slope bare minimum what we're seeing here and what we're seeing here. I would even argue that this slope was not downward sloped enough for us to trade it, right? A slope of this moving average specifically. So what we need here is basically just patience, okay? You know what to look for. You know it's a really simple thing. Again, this is the kind of angle we're looking for, bare minimum. You can see it right here. Notice that this angle is flattened out. We don't want to trade through that, okay? So even if you're watching long, short, whatever it might be, basically in that direction of the moving average, you don't go against it, and then you make sure that it's sloping enough in order for that to play out in your favor and ride the trend, okay? Now, the big issue and the big hole that you can poke in this is, well, Ferris, what if it's, just now sloping up and the move already happened? The good thing is, if you're using a lower length, right, medium to low, I would say, like 8 or 9 or 10 on the 5 minute, these are the moving average lengths, then you're going to have a good balance. It's proven. It's not something that I'm just pulling out of my ass here. This is a proven method, right? A lot of people use it, just slightly different time frames. Basically, as long as you wait for that slope, you're not going to miss the majority of the move. You're going to get at least a piece of that pie, okay? So that begs the question, we know what needs to happen. How exactly do we implement this? And again, it's as simple as just following the rule, but I'll show you one more example, and it's actually from today, this afternoon. So look how the moving average early in the day was indecisive, right? Not that it wasn't necessarily picking a direction, it just wasn't sloped enough, okay? Then as we start falling off, obviously there was another big strategy that played out here. If you're in the Trade with Text chat, you know what it is, just by looking at the action before this. And basically, once that moving average started sloping downward more, yes, this looks like a bait into the short, but you can wait for it to confirm, right? You don't actually need to jump into the trade in advance. You can wait and just get a piece of that pie afterwards, right? And that's exactly what we did in the chat today before I recorded this. So it's very simple. All you're saying is conditionally on the 5 minute, in order for me to trade, if the moving average is sloped this way, I can trade, I can check that box and say, okay, time to start using my strategies, right? And if it's not, you don't trade. And then the second part of it is that if that maintains, you can actually just get back in, right? So let's say, for example, I shorted the NASDAQ for that move, right? Shorted here, exited here, done. And then immediately the NASDAQ fires off another sell signal, right? We could zoom it into different time frames and analyze it a little bit further, but that's another sell signal. And that right there gives you another chunk of the move. So already by waiting for this to set up, you nailed a move from the initial leg down, right? Because that's when it started sloping, and then the round 2 right here. And that's 2 pieces of the pie in total. Okay, that's enough pie to go around. So that being said, this only basically has one more part to it, right? We know what needs to happen. Are there any ways that we can tweak this to make it more efficient? Now, one thing I'll say, the whole point of this webinar is so that if you are going into a trading day, you don't have any crazy bias, you're not forcing trades, and in addition to that, you don't need to trade every hour of the day. So by already asking, can we tweak this, we are kind of forcing trades that don't necessarily need to be made, okay? However, there are some different time frames that work. These are the ones that also work for me. So the 5 minute 8 works very well. The 5 minute 10, so this is the base time frame, right? And then that's the length of the moving average, okay? And then the 3 minute 12, believe it or not, I talked about it a little bit in chat today because one of the members brought up the 3 minute time frame. Believe it or not, this works pretty well. The 3 minute is good for scalping specifically. I don't really use it for anything else. It's also good at keeping you out of bad trades, but the 3 minute 12 EMA, I'll show you. You can use EMA or SMA, whichever you prefer. But if we set this to 12, and it's on EMA right now, exponential, so it'll be a little bit more responsive. And then we go over here and we go to, just has to be intraday, doesn't really matter, but we scroll up to 3 minute, okay, under our time frame. Look how much better that is. I mean, this is even arguably better than the 5 minute 8, but the tough part is once you lower the time frame, you'll get caught up in more nonsense, right? You'll get stopped out a lot more. So this is more useful, but again, it's gonna head fake you every once in a while to where the 5 minute 8 is a lot more consistent, okay? But it's really solid, 3 minute 12, okay? And I'll pull it over to that screen one last time to wrap it up. So basically, this is a simple rule. Just write it down on a sticky note. If not, it's going in one ear and out the other. Write it down, apply it to your trading, and during the summer months, especially in this volatile market, it will make you a lot of money. It lets you sit on your hands when you're supposed to, and it tells you to strike while the iron's hot. Okay, but if you learned something, some of you guys, this might be super simple, but again, it saves me a lot of money and makes me a lot of money. But if you learned something, like, subscribe to the channel, and in addition to that, again, we offer a free week in the chat. So you don't need a credit card, you don't need any of that. You can come in and learn for free for a free week. Okay, tradewithtex.com. All right, but thank you so much, guys. It's good to be back, and enjoy the Learn to Trade series. All right, take care.